If you only look at today's headline, you'll think silver just broke. If you look at the full data, you'll realize it didn't. And the difference between those two interpretations is the difference between reacting emotionally and understanding markets structurally. Today is Wednesday, February 18th, and the February silver contract just closed down $4.40 per troy ounce. That's a 5.66% decline in one session. Settlement printed at 73.447. It now stands as the second lowest settlement of 2026. It is the lowest close since Friday, January 2nd, 2026. Two of the past three sessions have finished negative. Month-to-date performance now sits at minus 6.19%. If that's all you read, the conclusion feels obvious. Social feeds are already framing this as a breakdown. Commentators are using words like collapse. Some are saying the bull cycle is finished. Others are telling holders to prepare for something worse. But here's the rest of the settlement report that doesn't make it into those headlines. Silver remains 152.26% above its 52-week low of $29.16, recorded on Friday, April 4th, 2025. It is up 120.45% compared to exactly 52 weeks ago. Year-to-date performance is still positive 4.72%, translating into 313 per ounce in gains since January 1st. And the settlement that's being described as catastrophic is still 4.10% above the 2026 settlement low of 75.56. Same report, same numbers. Two completely different narratives depending on what you choose to highlight. This is how financial perception gets engineered. Highlight the red percentage and fear spreads. Highlight the structural trend and context appears. Markets don't change based on what is emphasized. Only interpretation changes. Now let's break down what actually happened inside today's session, because settlement alone never tells the full story. Silver dropped to an intraday low of $72 before rebounding and hovering back near $74. That's roughly a $2 range inside a single session, representing about 2.7% intraday volatility. The key detail is not the drop, it's the reaction at $72. Price tagged that level and buyers stepped in immediately, not gradually, not passively, aggressively. When price touches a clean psychological support level and rebounds sharply, the footprint usually belongs to larger participants. The volume profile around $72 suggests institutional participation. Someone was accumulating there. Someone was defending that level. Retail traders do not produce that kind of response at a round number. Large capital does. So what actually caused the weakness? Two primary forces, neither of them tied to a sudden change in silver's physical supply or industrial demand. First, the US dollar strengthened. When the dollar index moves higher, every commodity priced in dollars faces mechanical pressure. It takes fewer dollars to purchase the same ounce of silver when the currency appreciates. That creates selling pressure even if underlying demand hasn't changed at all. This is currency translation, not structural weakness. Second, the geopolitical premium embedded into precious metals began to deflate. Reports indicated progress in diplomatic discussions between the United States and Iran regarding nuclear negotiations. At the same time, talks between Russia and Ukraine, mediated by American officials, suggested incremental movement toward de-escalation. Gold and silver carry embedded insurance value during periods of geopolitical instability. When perceived global risk decreases, that insurance premium reprices lower. What we witnessed today was partially that repricing. So the 5.66% decline reflects dollar strength combined with geopolitical premium compression. Now let's zoom out. From the all-time high of 115.8 reached on January 26, 2026, silver has declined approximately 36.18%. That sounds severe, but context matters. From the 52-week low to that January high, silver gained roughly 295% in less than 10 months. A 36% retracement inside a 295% advance does not automatically equal trend reversal. Technically, it represents a correction within a broader bull structure. Fibonacci retracement analysis typically expects support between the 38.2% and 50% retracement zones following parabolic extensions. Current price action is testing precisely those areas. Parabolic rallies do not consolidate gently. They correct violently. They remove weak positioning. They reset leverage. They shake out late buyers. Only then does the next directional phase reveal itself. The gold-silver ratio provides additional insight. The ratio has moved back above 66 and continues rising. This metric measures how many ounces of silver are required to purchase 1 ounce of gold. Historically, it has ranged from around 30 during extreme silver outperformance to above 100 during severe silver underperformance. At 66, we sit near the middle of that historical range. A few months ago, the ratio approached 80, signaling silver was deeply undervalued relative to gold. The compression from 80 toward the 60s fueled much of silver's outperformance. The recent expansion simply shows silver giving back some relative strength, not collapsing structurally. Institutional forecasts currently project a broad trading band between $70 and $90 for the foreseeable future. Some models extend upside targets toward $95 based on projected industrial demand growth and constrained mine supply. The prevailing strategy being circulated among major desks is buy on dips and sell on rallies within defined boundaries. That is range-based positioning, not collapse forecasting. Markets do not move in straight lines. They expand, retrace, consolidate, and expand again. The question is not whether silver dropped today. It did. The question is whether today's move invalidates the larger structural thesis. Right now, the data says no. The settlement printed at 73.447. It represents the second lowest close of the year. It represents short-term weakness. It represents mechanical repricing driven by dollar strength and geopolitical de-risking. But it also exists inside a structure where silver remains up 152.26% from its 52-week low, up 120.45% year over year, and still positive 4.72% in 2026. Same market, same numbers, different perspective. And in markets, perspective determines behavior. To understand where silver goes next, you have to step beyond the surface and examine the mechanics underneath the price. Markets do not move because of emotion alone. They move because of flows, positioning, liquidity shifts, and macro forces interacting at high speed. Today's 5.66% drop was not random. It was the product of identifiable pressure points converging at the same time. The first pressure point was currency strength. The US dollar index gained ground during the session, and when that happens, dollar-denominated commodities automatically feel mechanical compression. Silver is priced in dollars. When the dollar rises, the same ounce of silver requires fewer dollars to purchase. That mathematical relationship creates selling pressure independent of any change in real-world supply or demand. This is not theory, it is arbitrage. Large institutions constantly balance currency exposure and commodity exposure simultaneously. A move in the dollar index triggers automated adjustments in correlated assets. Silver's sensitivity to dollar movements currently runs near 1.8. That means a 1% rise in the dollar can translate into roughly a 1.8% drop in silver, assuming other variables remain constant. Now combine that currency pressure with geopolitical repricing. Reports suggested diplomatic progress between the United States and Iran regarding nuclear negotiations. Simultaneously, discussions between Russia and Ukraine, mediated by American officials, showed incremental signs of de-escalation. When perceived global risk moderates, the insurance premium embedded in precious metals begins to shrink. Gold and silver both carry what can be described as optionality against geopolitical chaos. When the probability of chaos decreases, even temporarily, that optionality loses value. What we saw in today's session was the dollar strengthening while geopolitical premium weakened. That double effect created compounding downside pressure. Notice what did not change. Mine output did not suddenly increase. Industrial consumption projections did not collapse. Solar capacity expansion did not slow overnight. Nothing in the structural supply-demand equation shifted dramatically on Wednesday, February 18th. The repricing was macro-driven, not fundamental deterioration. This brings us directly to the Federal Reserve. Through the remainder of 2026, Fed posture remains the dominant macro variable for precious metals. Market participants are intensely focused on the January FOMC minutes, searching for clarity about interest rate trajectory. Fed funds futures currently imply the possibility of a rate cut beginning in June. Rate cuts typically support gold and silver because they reduce real yields. Precious metals do not generate yield. When real yields fall, the opportunity cost of holding non-yielding assets decreases. Conversely, if the Fed reinforces a higher-for-longer stance, real yields remain elevated, and metals can struggle to build sustained upside momentum. The personal consumption expenditures report arriving Friday adds another layer. PCE serves as the Fed's preferred inflation measure. If inflation prints above expectations, rate cut probabilities decline and the dollar likely strengthens. If inflation prints softer than expected, rate cut expectations rise and the dollar could weaken. These macro variables influence silver far more than daily sentiment. Now let's move into technical structure because when volatility increases, levels matter more than narratives. Primary support currently rests between $70 and $72. The $70 level has been tested multiple times over the past month and has held. Each successful defense reinforces that support as buy orders accumulate around it. Beneath that lies 70.56, the 2026 settlement low. A decisive break of $72 would likely trigger stops clustered beneath the level and accelerate toward 70 quickly. Below $70, structural air extends toward the $64 to $65 region. which marked the February swing lows during the previous correction. Markets often move rapidly through areas lacking historical consolidation. That is why $72 functions as a gatekeeper. Until we see sustained daily or weekly closes below $70, the broader uptrend that began in April 2025 technically remains intact. Intraday volatility does not equal structural breakdown. Weekly confirmations carry more weight than temporary spikes. On the resistance side, the $78 to $79 zone remains immediate overhead supply. The 50-period moving average on the daily chart sits near 79.50 and has capped rallies recently. Above that zone lies more significant resistance between $82 and $83, marking the breakdown level from January's peak at 115.8. A decisive move above $83 with volume confirmation would indicate buyers have absorbed overhead selling, and that momentum could re-engage toward $90. Between $72 support and $83 resistance, silver currently trades in compression. This is what technicians refer to as neutral territory. Breakouts from compression zones tend to be forceful because positioning builds up within the range. While traders focus on short-term levels, the long-term demand engine continues operating. Silver remains the most electrically conductive metal available. That fact makes it indispensable in high-performance electronics and renewable energy infrastructure. Global solar capacity is projected to reach 665 gigawatts in 2026. The photovoltaic industry consumes roughly 20% of annual silver production, and that share continues to expand as panel efficiency improves and installations accelerate. Electric vehicle manufacturing requires silver for battery management systems and electronic controls. Artificial intelligence data centers require silver for cooling systems and high-voltage connections. These demand drivers are structural, not speculative. They are embedded in industrial expansion. Supply, meanwhile, lacks flexibility. Approximately 70% of global silver production is a byproduct of mining other metals, primarily copper, zinc, and lead. Mining companies base output decisions on those base metals, not silver alone. That means silver supply cannot rapidly increase simply because silver prices rise. This structural inelasticity contributes to projected annual deficits extending 6 consecutive years as global consumption exceeds production. Above-ground inventories have been drawn down to bridge the gap, but inventories are finite. The imbalance eventually requires price adjustment. Central bank behavior reinforces broader hard asset dynamics. While central banks accumulate gold rather than silver directly, their aggressive gold purchases over the past 3 years reflect diversification away from dollar-denominated reserves. Nations such as China, Russia, and India have expanded gold holdings significantly. That signal influences institutional allocation across the precious metals complex. Now consider the bearish case honestly. A sustained dollar rally toward 110 on the dollar index would intensify mechanical selling pressure on silver. Strong economic data could fuel such a move. If the dollar accelerates higher, silver could test below $70 and potentially revisit $64 to $65. If the Federal Reserve delays rate cuts beyond June and reinforces a prolonged higher-for-longer stance, real yields would remain elevated, limiting upside in precious metals. If geopolitical tensions continue easing, the embedded insurance premium in metals could compress further. And if $70 breaks decisively on a weekly closing basis, technical selling from leveraged participants could cascade. Finally, volatility itself must be acknowledged. Silver routinely experiences multi-percent daily swings. A 5.66% session is significant but not unprecedented in this market. Investors who cannot tolerate that level of movement should reconsider exposure regardless of fundamental thesis. Yet volatility is the same force that produced the 152.26% gain from the 52-week low. Upside opportunity and downside fluctuation are inseparable. They are two sides of the same equation. Silver is not experiencing structural collapse. It is testing support inside a consolidation shaped by macro forces. And that distinction matters. What makes this phase of the market dangerous is not the red candle, it's the narrative that forms around it. When silver settles at 73.447 after dropping 5.66% in one session and prints the second lowest close of 2026, emotion fills the vacuum. But markets are not destroyed by single sessions, they are reshaped by structure over time. Let's bring the broader performance back into focus. Silver remains up 3.313 per ounce since January 1st, reflecting a 4.72% year-to-date gain. That may not feel dramatic compared to the surge into late January, but in a year defined by violent equity swings, bond instability from rate uncertainty, and cryptocurrency moving through multiple 20% ranges, a modest positive return represents relative stability. The 120.45% gain compared to exactly 52 weeks ago is even more important. Anyone who owned silver 1 year ago is sitting on triple-digit percentage gains. The 36.18% retracement from the January 26, 2026 peak of 115.8 feels painful only because recent losses dominate attention. Recency bias amplifies declines and minimizes cumulative gains. Entry price defines emotional experience. An investor who bought at 29.16 in April 2025 views today's 73.447 settlement very differently than someone who entered near 115. Both are exposed to the same market. Both see the same volatility. But their risk perception diverges completely because their positioning differs. That dynamic becomes even more amplified when we look at mining equities. Companies such as First Majestic and Hecla Mining typically track silver's direction but with increased volatility. When silver declines 5.66%, these stocks often fall 8 to 12%. When silver rallies, they outperform to the upside as well. This is operating leverage in action. Fixed costs mean higher silver prices expand margins quickly, but falling prices compress them just as rapidly. Equity exposure provides magnified movement. Whether that leverage is appropriate depends entirely on risk tolerance and time horizon. Intermarket relationships offer additional clues. Platinum, trading near 2,000 per ounce after briefly dipping below that psychological level, has underperformed silver over the past year. The platinum-silver ratio has compressed significantly. That reflects divergence in industrial demand profiles. Platinum demand relies heavily on automotive catalytic converters and jewelry consumption. Silver demand depends on electronics, solar expansion, and advanced technology infrastructure. Automotive uncertainty weighs on platinum. Technology expansion supports silver. Both are precious metals, but their industrial drivers are not identical. That divergence influences capital allocation within the sector. Strategically, consolidation phases demand different behavior than trending phases. In a clear uptrend, buying pullbacks and allowing momentum to extend becomes logical. In a defined range, buying support and selling resistance becomes the dominant approach. Current institutional projections between $70 and $90 reinforce this framework. That is range expectation, not structural collapse forecasting. Position sizing typically decreases near range extremes because breakout probability increases. Breakouts from compression zones often become violent as accumulated positioning releases in one direction. The immediate catalysts ahead remain critical. The January FOMC minutes provide insight into how policymakers view the rate trajectory. A hawkish interpretation could strengthen the dollar further and pressure precious metals. A dovish tone could weaken the dollar and relieve mechanical pressure. Friday's PCE inflation report will shape expectations for June rate cuts. Above consensus inflation would delay easing. Below consensus inflation would accelerate it. Binary macro outcomes interacting with technical levels amplify volatility. The $72 support level remains central. It is held on multiple tests. Each defense adds liquidity and strengthens the psychological significance of that zone. A decisive break, especially on a daily and weekly closing basis, would likely trigger stop-loss orders beneath and accelerate towards $70. Beneath $70, structural error extends towards $65. On the upside, reclaiming 76ers would signal immediate selling pressure fading. Clearing $78 and $79 would suggest bulls regaining short-term control. A confirmed move above $83 with volume would reopen the path toward $90 and potentially beyond. Higher time frame closes matter more than intraday fluctuations. A weekly close below $72 carries more structural weight than a brief intraday spike. Sentiment indicators show fear building. Historically, pronounced bearish sentiment often develops closer to intermediate bottoms than tops in commodity cycles. When mainstream coverage declares bull markets finished, risk-reward often shifts compared to euphoric peaks. That does not guarantee immediate reversal, but it changes the asymmetry. Accumulation frameworks differ from trading frameworks. Long-term accumulation near the $70 to $73 range aligns with structural deficit projections and industrial demand growth. Short-term trading frameworks focus on the $72 to $78 band as the active battlefield. Global demand flows reinforce the structural story. Chinese and Indian physical demand cycles remain influential. European industrial activity, particularly in Germany, feeds into silver consumption. Middle Eastern investment flows have increased as regional capital seeks diversification away from dollar exposure and inflation risk. Silver is not a single region asset. It is shaped by global capital movements. The broader structural picture remains intact. Approximately 70% of silver production continues to originate as a byproduct of copper, zinc, and lead mining. That limits supply elasticity. Solar capacity expansion toward 665 gigawatts in 2026 continues supporting industrial consumption, which already accounts for roughly 20% of annual production. Electric vehicle manufacturing and artificial intelligence infrastructure add incremental demand layers. Annual deficits have extended for 6 consecutive years as consumption exceeds mine supply. Above-ground inventories have bridged the gap but cannot decline indefinitely. Structural imbalances do not disappear because of one volatile session. At the same time, risk factors remain real. Sustained dollar strength toward 110 would intensify mechanical pressure. Delayed rate cuts would cap upside momentum. Continued geopolitical de-escalation would compress risk premium further. A confirmed technical breakdown below $70 would shift structure. Acknowledging those risks strengthens analysis rather than weakens it. The settlement at 73.447 represents short-term stress. It represents mechanical repricing driven by currency strength and geopolitical recalibration. It does not represent sudden collapse of industrial demand or unexpected supply expansion. Markets oscillate between expansion and consolidation. The 36.18% retracement from 115.8 is significant, but it follows a 295% advance. Volatility is not malfunction, it is mechanism. Silver remains 152.26% above its 52-week low. It remains 120.45% above where it traded 1 year ago. It remains positive 4.72% in 2026. Those numbers coexist with today's decline. Perspective determines reaction. The bottom line is straightforward. Settlement printed at 73.447 after a 5.66% drop. Second lowest close of the year. Support at $72 attracted buyers. Dollar strength and geopolitical premium compression drove selling. Structural supply deficit persists. Institutional expectations remain between $70 and $90. Upcoming macro catalysts will shape near-term direction. Verify the data. Examine the settlement reports. Focus on structure rather than emotion. Silver is consolidating within framework until proven otherwise. That is the full picture.